From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, Treasury yields breaking out to new highs as Washington passes a $1.9 trillion plan. Economists racing to upgrade their forecasts. We begin with a big issue, yields hitting post-pandemic highs.
When the Treasury yield is going up,
we're going to see continued volatility.
Unprecedented fiscal stimulus.
$1,400 checks.
Explosive growth in the United States.
We're seeing the steepening of the yield curve play out.
It's a sign that the economic backdrop is improving.
The Fed's going to have to sound more upbeat on the economy,
which makes people nervous.
Will likely continue to challenge the Fed in their policy stance.
Yields are in absolute terms low.
The yields do need to go higher.
At what point does that rise in yields become too difficult?
Are we at that point right now? Joining us, BlackRock's Marilyn Watson, Nuveen's Tony Rodriguez, and Morgan Stanley's Jim Caron. Marilyn, let's start with that at the moment. Is the path of least resistance for Treasury yields still higher?
I certainly think that there's further scope for Treasury yields to go higher when you, in the backdrop, as you say, this enormous amount of fiscal stimulus that's coming through in the US, and there may be further, more to come as well in terms of infrastructure. When you look at the economic data, that's been pretty decent overall in the US, despite the weather. I think when you look at the overall backdrop of the vaccine rollout, which I know has been talked about a lot, but the opening up of the economy and the economy really getting back on track, I think the Fed is really going to try to sort of play down expectations. They've made it very clear that they're focusing on the dual mandate of unemployment being full employment, as well as the inflation target, wanting to repair the economy. But I think, in the overall backdrop, I think that the market is continuing to price rates higher.
163 on 10's up 9 basis points on a session. It's amazing, Jim, just to compare and contrast what's happening in the United States with what's happening in Europe right now. You might call this a statement of confidence in America, but looking to Europe, Italy's about to go into lockdown again across most of the country. And we're talking about higher yields in America. What does that mean for the rest of the world?
Well, I think that's a really good point. We shouldn't look at just the U.S. yield rise in isolation. Effectively, if U.S. rates are going up, it probably puts pressure on other yields to go up. In Europe, namely, we saw an ECB, meeting this past week where Christine Lagarde addressed this, and they're going to increase the pace of their pandemic emergency purchase program, the PEP program. And essentially, what we have to understand with Europe is that as yields rise, they don't have the capacity to do a lot of fiscal stimulus. So whereas in the U.S. we can say, hey, we're having stimulus or we're having these big relief packages going through, which is good, and that can push yields higher and that can get other asset prices moving higher. But Europe doesn't have that necessarily. They can't do as much fiscal stimulus. So a rise in yields in Europe is truly a tightening of what they call financing conditions. So I think they're going to have to play it pretty safe and try to increase these purchase programs such that those yields in Europe do not rise too high and out of control and create a premature tightening.
Tony, I'm trying to understand the optimal way of thinking about this right now, and there's three different ways. Either Treasury yields keep drifting higher and they take the rest of the world with it, bonds can anchor the rest of the world, or we get that dispersion turning into divergence in Treasury yields against bonds, the bond-Treasury spread getting wider. How do you think about it?
Well, good to be with you, Jonathan, and I think it's going to be the option of divergence. And the reason for that is because there's really fundamental drivers behind that divergence. In that, with the U.S., as we've mentioned already, there's fiscal stimulus, the economic data has been solid, and the vaccine rollout has been much, much better than what we've seen in Europe. So Europe is dealing with greater issues around the virus, kind of a one-trick pony around monetary stimulus without nearly as much fiscal stimulus, and they have structural kind of components of their economy that make it a little bit more difficult to achieve growth. So all of that, I think, structurally leads to lower rates there for longer than what we're going to see in the U.S., where here we are recalibrating to this much better both vaccine and economic growth outlook.
Marilyn, I know you're thinking about this too, and not just divergence between the U.S. and Europe, but also divergence within Europe. Can you paint me the picture you're expecting to materialise later this year?
Yeah, so we are certainly seeing, I think, increased divergence within Europe as well, and certainly we have improved, I think, our overall view on the UK, for example. So in our short duration in the UK, we think that the likelihood of having negative interest rates there from the Bank of England have significantly diminished, given the rollout of the vaccine, which has been very, very quick. given the data isn't going to be great given the lockdown that they have now, but it seems like the sort of the end stage of this current lockdown and total opening up of the economy sort of by the end of June, we think if that happens, would be very, very positive. We've also seen sort of a die down of all the issues and the uncertainty around Brexit. So I think we have the UK, which we're much more positive about. I think in other areas of Europe, as you say, it's much more dispersed. So in Italy, for example, we do have an overall positive view, given the fundamentals from where they are now in terms of the money that they're going to get through in the recovery plan, the fact that Draghi is now at the helm as Prime Minister and he's trying to push through a few different reforms. And given that we do still think that we can see further compression between Italy and Germany, and as Jim mentioned, we are seeing the ECB, which is really doing its best to keep financing costs down, and that means keeping borrowing costs for governments down.
Well, let's head back to Jim. Quite clearly, the lift in yields we've seen in Europe at times over the last month is not consistent with an improving outlook anytime soon on the continent in the economy. Jim, have we seen the capitulation as far as the US economy is concerned? By capitulation, I mean coming round to this view that we're about to have a massive boom in America. I've seen several forecasts, one from Morgan Stanley again, another upward revision to the forecast. The OECD out this week, lifting global GDP expectations by 1 full percentage point off the back of a $1.9 trillion plan over in DC. Have you sensed the capitulation yet?
So I haven't sensed it yet because the news just continues to get better. But I think that you're getting onto a good point here, Jonathan, which is that we are getting to a point where these positive surprises are going to start to just run out of steam, right? So if we go back to the start of this year, well, we had a positive surprise in terms of the vaccine, the rollout, the virus count. All of these things have gotten better. Growth has gotten upgraded. Retail sales in the U.S. has gotten a lot better. The employment numbers we expect to continue to get better. All of this is great. Unfortunately, this is all starting to become old news. So the way that I'm looking at this is effectively by the second quarter, we should have fully priced most of these surprises that we've had right now, and even potentially some in the future, because I still expect the data to be good, the jobs data to be good. Pretty soon, we're going to start talking about an infrastructure deal. We just signed a $1.9 trillion relief package. Now, stimulus, and there is a difference. This previous $1.9 trillion was a relief package, as Austin Goolsbee on Bloomberg earlier was saying. Yep. This new package coming up is stimulus. So that's going to be different. How big? So all of these things are going to be socialized in the markets over the next couple of weeks and even couple of months. But I think there's going to be a culmination of all this at some point in the second quarter, and that's where I expect yields to start to reach their peak. And once that happens, then I would argue that the traditional, more standard global reflation trade can actually start to take place, and it'll also be a little bit of a reprieve for Europe as well.
Tony, add to that if you can, please. As the bar gets higher, you need to be thinking about the additional sources of upside surprises. And to Jim's point, maybe it does come from policy, maybe it comes from DC, maybe they can do even more. Do you think they can?
I don't think that DC can necessarily do more after this $1.9 trillion. There'll probably be an infrastructure package. It'll probably be over 10 years. So the near-term stimulus for that may not be that large. But I think you'll continue to see forecasts increase for growth. Probably the biggest one that we're about to find out is next week, when the Fed has to upgrade their forecasts on growth. And what I think you're going to see is that 2020 was about financial markets and the equity side really pricing in advance of the recovery. A lot of spread sectors did that as well. So as we go into 21 here, spread sectors are priced for it, equities are priced for it. The Treasury market was recalibrating finally to pricing for solid growth. So when you look at returns, investors aren't going to be able to enjoy those double-digit returns from high-risk asset classes that we saw over the last 12 months. And now we're going to have much more muted returns through the balance of this year.
We need to talk about how the Fed responds to this too. Tony, Marilyn, Jim, stick with us. Up next on the programme, the auction block, the prospect of a little extra yield, bringing wary bond buyers back on board. That conversation up next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off here in the United States and look to the Treasury issuance this week. The highly anticipated 10 and 30-year auctions coming and going without any fireworks. The 3-year auction seeing robust demand and a spike in bids tendered. In corporates, American Airlines doing its part to keep the high-yield market active. Its upside offering putting monthly sales on track for the busiest March on record. And the high-grade market belonging all to Verizon this week. Its jumbo offering seeing strong demand and boosting this week's volume above even the highest of estimates. Back with us, I'm pleased to say, is Marilyn Watson, Tony Rodriguez and Jim Caron. Marilyn, let's look forward to next week, March 17th, the Federal Reserve meeting. And given what's happened in credit markets, is there any reason for them to be concerned whatsoever about financial conditions?
I don't think there's a huge reason for them to be concerned around financial conditions, in that they remain very, very loose, particularly in the US. Rates, real yields are actually still negative. You have, as you say, you have this huge stimulus from the government, but the Fed itself, I think, is going to be very, very careful in terms of really not signaling any change in their current policy. I know that the market is really looking to see what the the economic projections will show. They're looking what the dot plot will show. They're looking to see whether maybe the median estimate or forecast from the members of the FOMC might be to bring forward the first rate hike or any suggestion of tapering. We don't think that's going to happen. We think that the market obviously is now pricing in potentially a rate hike in 2023. It's possible, but it's probably unlikely at this stage. But so I think at the moment there's not a huge amount for the market to be concerned about. And it will certainly take some time, I think, for the Fed to move in a different direction.
Tony, I think Marilyn nails it. It's about the forecasts, and a GDP forecast, without a doubt, will be upgraded. We'll see significant upward revisions to the outlook over at the Federal Reserve, considering what we've seen from the South Side on Wall Street over the last several weeks. Tony, for me and for Marilyn, I imagine for Jim as well, it's going to come down to the corresponding move that we might see in the dot plot. What do you expect that to look like? GDP forecast up. Where did the dots go with that?
Yeah, so GDP up a lot, unemployment down pretty significantly, inflation maybe up 1/10. And what I think you'll see in the dot plot is right now you had 5 kind of dots that were in 2023. So you'd have to have 4 shift in order to shift the median into 23. I do think you'll get a couple shifting into 23. So they will begin to acknowledge kind of moving sooner for their first tightening. May not shift the entire dot plot, but I think they need to navigate carefully this idea that higher rates are healthy for the markets if they reflect solid growth and modest inflationary pressures reaching the Fed's target. But they have to be careful that they, in and of themselves, the higher rates, don't create kind of a reduction in negative feedback loop to financial conditions through either the equity market or rising spreads.
Jim, walk us through the sequencing that you're expecting, sir. Jim, just walk us through that.
Sure. Look, I mean, I think that no question there's going to be an upgrade to growth. There might even be a slight upgrade to inflation. But there's one thing that I'm looking for, and that is what does the Fed do with their expectation for the first rate hike? Now, we don't expect that there's going to be any sign of liftoff for policy rates to move higher until late 2023, possibly even early 2024. But this is a test to the Fed's credibility. And this is, I think, what the market's looking at. And the reason is this, is that whenever we look at 10-year yields, we have to recognize that it's really a math problem. It's really an idea of saying, how high can yields go? Well, part of the math that goes into that is what is the pace at which the Fed funds rate is actually going to start to increase? If we don't think that liftoff starts until, like the Fed is telling us, late 23, maybe early 24, but if we all of a sudden get a message from the Fed that it might start earlier, we're going to recalibrate those 10-year notes in a hurry, and those yields are going to go up. And that could cause a premature tightening of financial conditions if that yield rise is perceived as being too fast and too much. So the idea that risk premia can take 10-year yields higher because of inflation expectations, that's going to be based on growth. All of that is good. But really what the Fed needs to communicate is, because it's a test to their credibility, that they're not going to move, that they're still going to be patient, that they're not going to budge. That's what I'm looking for the most. If they move off of that, there's going to be something to do.
The test of credibility would be the doubting of the reaction function over at the Fed. And I think that, Jim, is if we see blowout data and start to see some movement at the front end. And I think last Friday when we got the payrolls report, that was the test. First test anyway. Big blowout payrolls report, front end anchored still. No test of the credibility yet. Marilyn, for me, where things get interesting is in the next couple of months, when you start to see inflation shift higher, we all expect it. CPI is going to be higher next month, the month after that. GDP is going to be better next month, the month after that, the next quarter, the quarter after that. We all know that's going to happen, barring anything surprising us from this pandemic. Marilyn, for me, it's not a question of economics, it's of psychology. How market participants respond to this, how they adapt their perceptions of what happens with policy. How are you set up to navigate what could be a choppy next 6 months for this market as that economy starts to gear up and push higher?
So we've already seen, obviously, the market be pretty choppy over the past few weeks as it's adapted to the change in growth expectations, change in certainly in inflation expectations. And I think as we move forward, as you say, we are going to see, we think, better data in terms of GDP growth. We will see probably inflation tick higher a little bit. But I think when you look at it in the overall context of the markets and where they're allocating their money, we still, see this huge demand and a huge amount of cash out there that really needs to find a home for it in terms of a return, in terms of yield. And I think we're going to continue to see that demand. I mean, you mentioned it earlier in terms of the auctions that we saw this week. They were pretty successful. And so I think sort of looking this, we are going to see choppier markets. We're going to look to see maybe the markets a bit more dispersion as well in terms of where investors are placing their money. We, for example, have slightly sort of changed our allocation a little bit to maybe be a bit further down the quality spectrum in terms of our corporate allocations in a global portfolio. So I think, but when you look at inflation, I don't think you're going to see inflation sort of accelerate too much. We will see it tick higher, certainly, but I think, certainly with commodity costs rising, with production costs rising, and as economies open up. But on the other side, I think we're going to continue to see this sort of suppression in terms of, demographics and terms of technology. I don't think we're going to see inflation really sort of shoot out, but we will see it rise slightly higher.
Tony, you can see how everyone's set up at the moment, increasingly short duration, lower down in quality. Do you worry that everyone's running to the other side of the boat too quickly?
Yeah, it is becoming a crowded trade, Jonathan. You make a great point. And I think that maybe limits some of the upside of it because people are already positioned for it. But I still do agree that it makes sense to be defensive on duration. You're going to see a steeper yield curve. And the way we try to approach that in terms of the spread sectors is don't be at the maximum of your risk kind of capacity, risk budget, so that when you have these, what we believe are going to be inevitable spikes in rate volatility, and they do feed through to the broader financial markets, both the equity side and spread sectors, that you have some dry powder to take advantage of that, add some risk, because we do think that mid-quality credit world is going to outperform over the balance of the year. Final word here, Jim.
Yeah, it's a pro-cyclical story. I think some of the down in quality trades, which I know have been very, very popular, have been working. But what's really been working is the reduction in interest rate sensitivity. So within your portfolio, if you can hedge out the interest rate sensitivity or the duration risk in the portfolio, but you can take the credit risk, because credit has actually been holding up pretty well in terms of spreads this year. And that's where really the money is being made. But you do have to watch out and hedge for your duration.
Jim, Marilyn, Tony, stay close. Still ahead, the week ahead, featuring a Fed rate decision and Chairman Powell's news conference. That conversation coming up next from New York. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up next week, two big pieces of economic data coming on Tuesday, Thursday, with retail sales and initial jobless claims, plus global central banks active, a Fed rate decision and Chairman Powell news conference on Wednesday. Then it's the Bank of England's turn on Thursday, all rounding out the week with the Bank of Japan on Friday. Back with us, I'm pleased to say, for a final word is Marilyn Watson, Tony Rodriguez and Jim Caron as well. Tony, I wanted to finish on something important that takes place in the next couple of weeks, and it's not the Fed decision next week. It's a regulatory decision that needs to take place before March 31st. And I'm sure some of our viewers, particularly those in fixed income, are well aware of what happened last year around the supplementary leverage ratio and basically allowing people to hold more treasuries, exempting treasuries from that. Tony, can you walk me through what you expect to happen in the next couple of weeks and the implications that could have?
Sure. I mean, it's a negative technical for the market if they don't extend that exclusion for treasuries and excess reserves. Banks will not be forced to sell immediately because most of them still exceed their minimum ratios, even if you remove the exemption, but they get a lot closer to what that minimum is, and they don't like being that close to it. So at the margin, it will kind of either reduce demand for treasuries at the front end in particular, or cause some selling. So that's going to add volatility to the market that the Fed is going to have to address through liquidity measures to make sure that you don't have any instability in the front end of the market, which, as you had mentioned earlier, anchoring that front end is key to Fed credibility over the next couple of years.
Jim, 2-point question here. First, do you think it's having an effect already? And secondly, do you think that it actually expires month end?
No, I don't think it actually expires month end. I think the Fed is well aware of what this can do. And we saw what happened the last time, rates went up and the curve flattened. That was very, very negative for risky assets, whether it was high yield, investment grade, equities, whatever the case may be. So I think the Fed wants to avoid that type of premature tightening, especially on a technical thing that they can really just, change on their own without having much problem. So, I think the technical aspect of putting more Treasury supply into the front end during a period of time where you have a lot of, relief packages and stimulus packages that may be forthcoming, that could create a tightening financial conditions that I think would really work against a lot of what the Fed is trying to achieve. So I think that this exclusion will be extended beyond March 31st.
It's a really important topic, and we'll spend a lot of time next week on this program talking about it as we count down to that March 31st date. I want to wrap things up with the rapid fire round. 3 quick questions, 3 quick answers. What do we see first? 3 questions based on that theme. Do we see 2% on 10s or 1% on 10s? What comes first, 2% or 1% on a 10-year yield? Marilyn?
2%.
Tony?
2%.
Jim?
2%.
Let's carry this on. High yield spreads right now in and around 325. What comes first, 350 or 300? Jim?
300.
Tony?
300.
Marilyn?
300, yeah.
All on the same side of the boat here. Let's finish on this one. ECB President Christine Lagarde this week. And a big question for Europe. Can they engineer a recovery that actually leads to higher interest rates? So what comes first, an ECB rate hike or the end of President Lagarde's 8-year term? An ECB rate hike or the end of President Lagarde's 8-year term? Tony?
The end of her term and probably the next governors as well.
Jim?
I'll say a rate hike.
Marilyn?
Maybe a rate hike, yeah.
Guys, great to catch up. Appreciate your time. Marilyn Watson there, Tony Rodriguez and Jim Caron as well. From New York City, for our audience worldwide, we'll see you same time, same place next week. 6 p.m. in London, 1 p.m. in New York. This was Bloomberg Real Yield. This is Bloomberg.